Good day, all. Ira Epstein of Linn Associates with your financial market wrap-up, and this is for Monday, the 25th of March, 2019, just getting on to 4:42 p.m. Central Daylight Time. A very mixed day in the stock market. You know, over the weekend when we heard that Robert Mueller's report was released, and I kept wondering how the markets were going to react. The first calls we had last night were up 100 points in the Dow. It really didn't occur that way. You ended up opening higher, then giving a lot of that up. You ended up the day about 7 ticks higher. A mixed bag because the S&P was down, the NASDAQ was down. The Dow probably helped a certain amount today by, Apple, things of that nature that were going on. We'll see if that works out. Metal markets getting a bid in them as the dollar index sank back. Here's still what's working in the market. The curve yield. Every time futures go higher, it means that real rates are dropping. That's typically what they mean. Then if you go to the CME Group's Fed Watch page, you start applying what the pros are betting on at this point for the rest of the year. And what I'm looking at is a 62% probability of an interest rate decline in September, 75% by December. So the market is flipping around and saying to the Fed something different than the Fed's doing, which is staying flat. So we're getting a greater probability now of breaks, not hikes any longer. When we take a look at the S&P, you can see how the market is just sort of plateaued here in this 2807 area, 2800 zone. You can see how it's come up and what's going on now on the daily bar chart, which is sideways action. Now the question was this a shoulder and that a shoulder, and would the market carry up to account? In order to do so, it's got to take out the highest high, and until that occurs, the market has a problem. Now what the problem is it's lost direction. You have a pattern of a higher high and a lower low. That is not a trend. When I take a look at the 18-day average of closes, you finished at 2807. The 18-day average is 2806. Remember what I tell you. Markets that get ahead, upside, and if they break, sometimes they'll get back to that 18-day average, and that's where a battle can ensue, is the market's looking for its next direction. If you break from here, the 200-day moving average comes in at 2769. What stopped the rally? Well, what stopped the rally was the upper Bollinger Band, and we talk about that so often here. That is where the pros, in my opinion, were taking money off the table. The first time it hits it, they'll do it here, backs off, they might buy again. This acts as your resistance area, and that's what we're seeing in the market. Add to that the fact that momentum is turned down, and what you've lost is direction in the market. No bias. The bias would be up. If anything, it's over the 18-day average, but the momentum is down and you're void of a trend. When I come to the NASDAQ, the odds are strongly favoring right now that price and the 18-day average are going to make a run at each other, and that is because you lost the embedded reading on the close. Now, if you see, I'll take this back. Each day, the numbers were both over 80 for a good amount of time here. When you lose it, the only time you can get it where they both go back over 80 is immediately, literally, the next day. And if you don't get that, it often leads to price in the 18-day average, just like I'm saying, going back to that line in the sand, trying to figure out what to do. In this market as well, you've lost the pattern. You've got a lower low and a higher high. So you're out of that up swooping pattern that this market had when the FANGs were leading it higher. As you look at the Dow, you're caught in this basic sideways pattern here. Momentum is pointing down. Again, like the other indices, a lower low, higher high. However, I think the shorts were pulling in those positions when you hit the lower Bollinger Band at 25,433, and the market rallied from there about 140 points higher on the close. In the Russell, if you take a look at the action from Friday, lower highs, lower lows on the daily chart, and you closed under the lower Bollinger Band. First thing, you only close under or stay, let me say it the right way, you only stay over an upper part of a band or lower part of a Bollinger Band 5% of the time. That's what the algorithm is built to do. So here you're under it. The next support would be the 100 what, day average of closes in green. You have a market on Friday that had a reading under 30. It's oversold. I am expecting short covering. Not new buying, short covering. There's a big difference. Whoops, let me get here. Market goes down, hits the 100-day average, bounces. Because it's oversold, I don't know if the pros are going to be willing to sell back onto this rally until I would think the market gets out of the oversold condition. In the VIX, you know, one of the things that I look for in markets is if you hit lower bands or higher bands, one of the processes I've been noticing is that the pros seem to be on the lower band, selling puts, getting out at the 18-day average. On the upper band, I think they're selling calls. The risk on the upper band is more than on the lower band, only because in the lower band you got a reading of 12. You're not going to go down to a reading of 3. But you can take that's typically what happens. But you can take a 12 like you did back over here. You can explode to the upside if a surprise hits the market. I did a piece on TikTok today saying to people, you know, what had happened is everybody got complacent again. And when they get complacent because the market's just going to keep going up because it's done it for 10 years or so, they look at the market and they feel they don't need insurance. That's about the time you need it. In the T-bonds, you continue to climb. Now, you're 2 days, or I think it's 3 actually, over the upper Bollinger Band. I'm not wrong on that. This market closed at 147.4 there. So Friday was the first day over. Today is the second. You have an embedded reading. Embedded means that both the K and the D lines, the red and the blue, are going sideways over 80 more than 3 days or 3 days or more. Therefore, on pullbacks in the market, I'm looking for the pros to continue to buy until that red line falls under 80. In the 10-year notes, if we come here, how many days did we have over? Friday, Thursday you closed under the Bollinger top. Friday over it. Today over it. So just like in the bonds, you've got the embedded reading. This market's had an embedded reading for a much longer time. And what it has succeeded in doing is, if you come back here, look at the sideways action that we had. And what you probably can go back to my tapes, they're out there. I generally say when this happens that this market's going to be soon coming into a trend. And it's not uncommon you get it to go one way, you try the other, but this was the time when it started pushing on that band that it actually got itself into that uptrend. So it's there until, in my opinion, the red line on the slow stochastic closes under 80. I'm expecting on breaks still to be aggressive buyers showing up. TLT, the same type of chart, not quite as good as the futures because you got a lower low and a higher high, and you are now 2 days in a row also over the upper Bollinger Band and embedded as well. In the dollar index, battleground, 18-day average of closes. That is what I have termed the line in the sand. Now, some people use a 20 or a 21. They're going to be so close it doesn't matter. I'm much more comfortable with this for a lot of reasons that I've used the others over the year. I've bought services to try to, if you will, optimize what average is best for each market. And I found that I can optimize just as well if I go back in time and just try to figure out, okay, what's the current environment? And just about the time I do that, the environment changes. So I ended up coming to the 18, and I'm very comfortable with that. Eurocurrency, battleground, 18-day average of closes, trying to figure out what to do next. Is it trending? No. You got a higher high, lower and low. By the way, the dollar, you got lower and lows, higher highs. There's no trend out of that market either. In the British pound, you've had a pattern of lower highs, lower lows, but you have to give this market credit and pay attention. You got Brexit, maybe a hard Brexit coming. This market's not breaking. If anything, it keeps stabbing up to higher highs. Difficult market for those that want to trade the fundamentals and think that Brexit's going to hurt this market. The chart's been different. Now, if we look at today's close at 132.37, it is under the 18-day average. So, for the moment, you've got lower highs, lower lows, certainly. You're under the 18-day average. The bias is down. Momentum is flat. I'm going to call the trend down until this market takes out on the current formation, 133.71. Japanese yen, a lot of people seem to, you know, when you get uncertainty in financial markets, the yen comes alive. And they run to safe havens. It could be a bond, it could be a note, it could be the metal markets, it can be also the yen. And the yen has got that, and it's trying to push out this trading range of this sideways action. Trend up, bias up, ahead of itself, overbought. 2 days in a row over the upper Bollinger Band. I think that the pros are waiting for the market on pullbacks, but because it's overbought, I don't expect them to be aggressive. In Bitcoin, Bitcoin's getting no bid out of this safe haven play. It's pulled back to the 18-day average of closes without a trend. It wasn't strong enough to get up to the 100-day average. It did get to the Bollinger Band, and I think the market has now got momentum turning down against it. Could slip a little bit here. More, what I expect is fighting at that 18-day average of closes. In the energy complex, as you can see, as the numbers are going up, it means that Brent is gaining again on WTI. This is the spread difference between the two grades of oil. And if we take a look at what's going on here, you have a pattern. If we take a look at this last break low, I don't know if I brought this up to date, but that number is 66.09. So just visually, I can see that you stepped out of your trend. The market at 65.99 took this out. I should have had this arrow pointing down in red with a pattern of a higher lows and a low, now a lower low and a higher high is the right way to say it, caught inside the sideways action of the Bollinger Band, and the fact that momentum lost itself and is turning down, I just expect churning in this market. In WTI, it's the same pattern. I at least did this one right. Lower low, higher high. You lost the embedded reading today. Now, if you take a look, you made a run at the same time for that number. You got 58.07 is the 18-day average. You hit 58.17 as a low. A lot of times I'll say, you know, this market could be a short sale looking for the challenge of the 18-day average by some traders. Not by, you know, I'm not giving you a rec. I don't know that they'll do that here because the market's so close. In gasoline, as long as the embedded reading stays alive on pullbacks, I'm expecting buyers. And notice since this has been embedded, how shallow the breaks have been. Now, if you lose that reading, I then expect prices to break through to the 18-day average and look for support at that number. Resistance now, 192.58. All systems are still bullish. In the nat gas, the market came down, and this was last Thursday. So you see a support if you break down at the lower Bollinger Band and the 100-day average. You still had at this point higher lows and a higher high. On Friday, you broke down through this number, giving you a pattern of a higher high, lower low. And I realize people get all excited when they see that and they go, this is where it's going to let go. I don't know about that. The 100-day average and the Bollinger Band are formidable on the first challenge of them. And you can see today that while you broke a bit lower, you tried to hold those two numbers. So that's where I think we're at. I wrote my metal report, and you know, I keep using the word right. Now, today I'm making a lot of mistakes in my grammar, apparently. I videotaped a metal report for gold only today. So I'm bringing you up to date on what I'm seeing in the market. And how I'm doing it, by the way, is I'm using some seasonal charts. In this report, I used a monthly chart. I did not do any price counts because I had price counts up and down that were all hit. So we're waiting for a new setup in them. But I do think you're in an important zone. How you get to see the report, you don't have to call us, but you're welcome to. Just go to our website at www.iraepstein.com. Go into the word education, look at the drop-down menu. You'll see the gold report. Click on it. You'll be able to view it and get an idea of what I'm looking at. I'm Ira Epstein. See you tomorrow. Have a great night.